It's Tuesday afternoon, January 7th, 2026, and I need to show you something that should not be happening right now. I'm looking at silver, and the price is sitting at $78.60 per ounce, down $3.89 today, down 4.71%. The financial media is calling this a healthy correction after silver's run from $30 to $82.50 over the past few months. They're telling you this is just profit taking, just the market cooling off, just gravity doing its thing. But while you're watching that red candle on your screen, there's a completely different story unfolding in the physical delivery vaults at the COMEX. And it's a story that the mainstream news cycle won't touch for another 12 hours, if they touch it at all. Because right now, they're busy covering gold's minor dip to $4,460, completely ignoring what might be the first tremors of a genuine black swan event in the silver market. Here's what I mean by that. The screen is lying to you. While the paper price ticker flashes red and the talking heads celebrate the return to sanity, the physical vaults are hemorrhaging white metal at a rate we haven't seen in decades. The real story today isn't the price drop. The real story is who is desperately trying to keep the lid on this pot before the entire thing explodes in their face. And here's the part that should make your ears perk up. What's happening in the COMEX delivery notices right now shouldn't even be possible in the month of January. Let me explain why that matters, and why the math behind this is starting to look very, very grim for the bullion banks. My name doesn't matter, but my background does. I've been analyzing commodity markets and stacking physical silver for 12 years now, and I built this channel because I was tired of waiting half a day for Bloomberg to report what I could see happening in real time on my terminal. You're going to see a lot of AI avatar channels popping up with recycled news and manufactured hype about precious metals. I'm using this technology for one reason: speed. I want to get you the real data, the real analysis, before the narrative gets sanitized and spun by the financial press. So here's what I'm going to lay out for you today. My primary claim is this: bullion banks led by JP Morgan are aggressively suppressing the paper price of silver at the $82.50 resistance level to manage an unprecedented surge in physical delivery demand during what is supposed to be a dead non-primary delivery month. These banks are underwater on massive short positions, and they're using every algorithmic tool in their arsenal to kill this momentum before they lose control of the physical inventory sitting in those vaults. And the trouble they're in? It's big. Bigger than most retail investors realize. Here's my promise to you for the next few minutes. I'm going to pull back the curtain on what I'm calling the non-primary delivery squeeze. I'm going to run the actual math on the 23.5 million ounces currently in flight for delivery. I'm going to show you the $137 per ounce reality that's already happening in the East, while the West pretends everything is fine. And I'm going to share exactly how I'm positioning my own portfolio as this so-called brick wall at $82.50 begins to show cracks. Let's start with what the screen is actually telling us right now, and then I'll show you why it's incomplete at best and deliberately misleading at worst. A few hours ago, at noon Eastern, silver was trading at $78.60. That's down $3.89 from yesterday's close. The chart shows a rejection right at that $82.50 level. Now, if you've been trading for any length of time, you know what real selling looks like. Real selling is a curve. It's messy. It's emotional. It's driven by thousands of individual decisions cascading into each other. Stop for a second and look at that $82.50 level. That's not a curve. That's a flat line. That's not organic market behavior. That is a surgical strike designed to kill upward momentum before it gains enough velocity to break through resistance. This is the kind of price action you see when someone with very deep pockets and very sophisticated algorithms decides that silver cannot, under any circumstances, be allowed to trade above a certain threshold. Now, here's where it gets interesting. While the COMEX paper price is flashing $78 and change, let me tell you what's happening on the other side of the planet. I pulled up the Joyalukka's website this morning. They're one of the largest jewelry retailers in India. They're selling 10-gram silver bars for 3,982 rupees. Run that through the current exchange rate and the conversion to troy ounces, and you get $137.85 per ounce. Let me say that again. While the West is pricing silver at $78, the East is selling it at $137. That's not a premium. That's not just import duties or taxes. That's a 75% divergence between the paper price and the physical reality. That's what happens when the supply-demand curve in a region completely collapses. That's what a genuine shortage looks like when it hits the retail level. But here's the part that should really get your attention. In the first 3 trading days of January, the COMEX issued 4,697 delivery notices. Each contract represents 5,000 ounces of silver. Do the math, and that's 23.5 million ounces being yanked out of the system in 72 hours. In January, a month where almost nothing is supposed to happen. So we have a paper price that's falling while physical demand is exploding. We have an east-west divergence that's approaching levels we haven't seen since the Hunt brothers era, and we have bullion banks scrambling to issue delivery notices at a pace that should only happen during active contract months. The paper price is a tool for the banks, but the physical reality is dictated by the fact that nearly 24 million ounces are being pulled out of inventory in a month where the vaults were supposed to be resting. And here's the uncomfortable truth that nobody wants to say out loud. If the banks can't find that metal, the paper price becomes completely irrelevant. Let me teach you something about how the COMEX delivery system actually works, because this is the mechanism that explains why January's surge is so dangerous for the bullion banks. Silver futures contracts have what we call active delivery months. Those are March, May, July, September, and December. Those are the months where everyone expects large-scale physical delivery. The vaults are staffed. The logistics are prearranged. The bullion banks have their short positions laddered and their inventory plans mapped out months in advance. Then you have the off months, or non-primary months. January, February, April, June, August, October, November. These are supposed to be the quiet periods. These are the months where maybe a few industrial users take delivery for operational needs, but the vast majority of market participants just roll their contracts forward to the next active month. It's easier, it's cheaper, and it keeps the system flowing smoothly. Think of it like this. Imagine you run a grocery store and you have planned your staffing and inventory around the fact that Black Friday is going to be your busiest day of the year. You've got extra cashiers scheduled, you've got pallets of product staged in the back, you're ready for the stampede. Now imagine that same Black Friday level stampede happening on a random, snowy Tuesday morning in February. You've got 2 cashiers working, your storage is half empty because you weren't expecting volume, and suddenly there's a line of 300 people at your door demanding products you don't have on hand. That's what's happening in the silver vaults right now. When 23.5 million ounces get demanded in January, it means that industrial users, sovereign buyers, and large-scale investors are so concerned about a potential shortage that they can't even wait 60 days for the March contract to go active. They're willing to pay the extra fees, jump the queue, and take physical possession right now, in the dead of winter, in an off month, because they believe that waiting is more expensive than acting. And here's why that's a nightmare for the bullion banks. These banks usually structure their short positions with the active months in mind. They know that March is going to see heavy delivery, so they make sure they've got the metal lined up. They've borrowed it from ETFs, they've leased it from central banks, they've cobbled together enough inventory to meet expected demand. But this January surge caught them with their guard down, and we know this because of what happened on Tuesday. JP Morgan issued 63 out of 150 delivery notices that day. That's 42% of the total. Think about what that means. JP Morgan isn't issuing that many notices because they're feeling generous. They're issuing them because they're the lender of last resort. They're filling the gaps where other banks are failing to deliver. They're the ones keeping the system from seizing up completely. But JP Morgan's pockets aren't bottomless, and the math is starting to look grim. Let me walk you through the numbers, because this is where the situation goes from concerning to potentially catastrophic. We're 3 trading days into January. We've already hit 4,697 contracts delivered. That's 23.5 million ounces. Now, let's be conservative and assume that this pace doesn't hold. Let's assume demand drops by 50% from here. Even in that scenario, we're on track for a 40 million ounce delivery month. The last time January saw 40 million ounces in deliveries? Never. It's never happened. January delivery records don't even get close to that number. We're in uncharted territory. But let's say I'm being too optimistic. Let's say the momentum from these first 3 days continues. Let's say industrial users keep panicking and sovereign buyers keep jumping the queue. If the current pace holds, January could demand more silver than the vaults currently have in registered status. Registered means available for immediate delivery. As of last week, we had around 90 million ounces in registered inventory across all COMEX vaults. If this pace continues, we could burn through 40 to 50% of that inventory in a single off month, before March even starts, before the next active delivery period even begins. Now let's talk about JP Morgan's role in all of this, because this is where you start to see the desperation. JPM issuing 63 out of 150 notices on a single day is not normal behavior. That's not a bank managing a balanced book. That's a bank acting as the systemic backstop. That's the behavior you see when the pipes are clogging and someone with deep reserves has to step in to keep the flow moving. And here's the absurdity that should make anyone with a functioning calculator scratch their head. The price is down 4.71%, while physical delivery demand is hitting historic record-breaking highs for a non-primary month. Those two things cannot coexist in a rational market. If demand for physical metal is surging, the price should be surging with it. If the price is falling, delivery notices should be falling too as buyers back off and wait for cheaper entry points. But that's not what's happening. The math literally does not add up. When the math fails, the system breaks. And the skeptics are running out of excuses. Now, I know what the pushback is going to be. I've been doing this long enough to anticipate the arguments from people who don't want to believe that something structural is breaking in the silver market. So let me steelman the skeptical position and then show you why it doesn't hold up under scrutiny. Skeptic argument number 1, this is just a technical correction. After silver ran from $30 to $82, a 5% dip is just normal profit taking by large hedge funds. You're making a mountain out of a molehill. Here's my rebuttal. Profit taking happens in the paper market. When a hedge fund wants to lock in gains on a silver position, they sell the futures contract. They close the trade on the screen. They don't pay storage fees, insurance, and logistics costs to have 5,000-ounce bars physically shipped to a warehouse they control. Physical delivery is expensive, it's slow, and it ties up capital. So if this were really just a wave of profit-taking, delivery notices would be falling, not spiking. The people taking delivery right now aren't taking profits. They're taking cover. Stop for a second and think about the psychology here. If you owned a silver contract at $82 and you wanted to take profit, would you go through the hassle of arranging physical delivery? Would you pay the premiums and the fees to have actual metal shipped to you? No. You'd sell the contract, take your cash, and move on to the next trade. The fact that 23.5 million ounces are being withdrawn tells you that these aren't speculators cashing out. These are buyers who believe that having the physical metal in hand is worth more than the paper promise of the contract. Now let's talk about the Indian premium, because the skeptics love to dismiss this as just taxes. India does have high import duties on precious metals. I'm not disputing that. But even accounting for those duties, a 75% premium is not normal. A 20 or 30% premium might reflect taxes and logistics. 75% reflects a total collapse of the local supply-demand curve. That's what happens when there's no metal available at any reasonable price. That's what a genuine physical shortage looks like when it cascades into the retail market. The skeptics want to call this a correction. The data calls it a bank run in slow motion. So what happens next? Let me map out the scenarios I'm watching, because the next few weeks are going to tell us whether this is a temporary squeeze that gets managed or the beginning of something much larger. First, let's recap where we are. We know the price is being capped at $82.50. We know January is seeing Black Friday levels of physical delivery. We know JP Morgan is scrambling to fill orders when other banks can't. Those are the established facts. Here's what I'm watching for on the institutional side. If the COMEX can't control this with price suppression, they're going to try to control it with rule changes. Historically, when exchanges get into trouble, they hike margin requirements. That forces leveraged speculators out of their positions and reduces open interest. It's a way to cool down the market without admitting there's a problem. But if margin hikes don't work, the nuclear option is cash settlement. This is where the exchange basically begs contract holders to take paper dollars instead of physical bars. They'll offer a premium above the spot price to incentivize people to go away quietly. If you start seeing cash settlement offers in January or February, before the March active month even starts, that's your signal that the vaults are in serious trouble. Here's my dashboard of indicators that I'm checking every single day. First, registered inventory. If it drops below 30 million ounces, the game is over. There's no way the system can service March deliveries plus ongoing January and February demand if registered inventory falls to that level. We'd be looking at force majeure declarations, delivery delays, and a complete loss of confidence in the COMEX as a price discovery mechanism. Second, the 82.50 ceiling. If a weekly candle closes above 82.50, that tells me the algorithmic suppression has failed. That tells me the brick wall has crumbled and we're moving into price discovery mode where the physical shortage starts to pull the paper price higher by sheer force. Third, watch JP Morgan's delivery issuance. If they're still issuing 40 to 50% of total notices a week from now, that confirms they're the only bank with enough inventory to keep the system functional. And if JPM ever steps back and stops issuing at that rate, you'll know they've decided to preserve their own position rather than save the system. They can manipulate the price, they can suppress the chart, they can paint red candles all day long, but they can't print silver atoms. And that's the ultimate constraint that makes this situation so dangerous for them. Now let me tell you exactly what I'm doing with my own portfolio, because I want to be crystal clear that I'm not telling you what to do. I'm sharing my personal battle plan, so you can see how someone with 12 years in this market is thinking about the current setup. Here's my watch list as we head toward the March primary month. I've got two main triggers that would cause me to adjust my positioning. Trigger A is the dip scenario. If silver falls toward the $75 psychological support level, I'm not panicking. In fact, I would look to increase my physical holdings. Here's why. The divergence between the COMEX paper price and the physical reality in India tells me that the real floor is much higher than what the ticker suggests. If I can buy physical silver in North America at $75 while it's trading at $137 in India, That's not a falling knife I'm trying to catch. That's a mispricing that I want to exploit before the gap closes. Now, I'm not talking about leverage here. I'm not talking about futures contracts or options. I'm talking about buying actual bars and coins from reputable dealers and taking personal possession. Because if this situation deteriorates into a genuine shortage, the paper markets might offer you a great price that you can't actually execute at. You'll get filled on the screen and then wait 6 months for delivery, if it comes at all. Trigger B is the squeeze scenario. If COMEX registered inventory drops another 5 million ounces this week, I'm sitting on my hands regarding paper trades. I will not short this market, no matter how many red candles they print on the chart. Here's why. In a physical squeeze, the paper price can stay irrational far longer than you can stay solvent on a short position. We've seen this before in other commodity markets. The paper price says one thing, the physical reality says another, and eventually the physical reality wins. But the path from here to there can be chaotic and violent. And I'm not interested in being the guy who had the right thesis but got margin called before the payoff. Now here's the scenario that nobody wants to talk about, but everyone should be preparing for. What do I do if the COMEX declares a force majeure or starts forcing cash settlements? If that happens, I would immediately pivot 20% of my metals allocation into senior mining equities. Here's the logic. When the physical market breaks, there's usually a lag before the equity market catches up. The miners still have the metal in the ground, and their production becomes exponentially more valuable if the spot market is broken and physical premiums are exploding. Historically, when you see disruptions in physical delivery markets, the equities create a secondary explosion as investors realize that owning the source of the metal is the next best thing to owning the metal itself. But I want to be clear about something. I'm playing the long game here. I'm not watching the red flickering lights on my phone and making emotional decisions based on intraday volatility. I'm watching the vaults. I'm watching the delivery data. I'm watching the behavior of the bullion banks, because those are the indicators that tell me whether this is a temporary squeeze that gets managed or the beginning of a structural breakdown in the paper-silver market. I've been in this market long enough to know that most breaking moments don't break cleanly. They crack slowly, then all at once. And what I'm seeing right now in the January delivery data looks a lot like the early stages of a crack. Let me bring this together and tell you what I think is coming in the weeks ahead. Here's what we know for certain. Silver is being suppressed at $82.50 despite a 23.5 million ounce physical delivery run in what's supposed to be a dead month. JP Morgan is holding the line, issuing nearly half of all delivery notices just to keep the system from seizing. And meanwhile, the East is already trading physical metal at $137 per ounce, a 75% premium over the Western paper price. The brick wall at $82.50 is made of paper, but the demand behind it is made of steel. Here's my forecast. If this pace continues, we're going to see one of two outcomes before March. Either the COMEX successfully kills momentum through price suppression and margin hikes, and we get a temporary reprieve, where the system stabilizes and people forget this ever happened. Or the vault inventory drops to critical levels, the banks lose control of the narrative, and we move into a genuine price discovery phase where the physical shortage pulls the paper price higher, whether the bullion banks like it or not. I'm leaning toward the second scenario, but I'm positioning for both. Because the thing about structural breaks in commodity markets is that they tend to resolve faster than anyone expects once the pretense falls away. When everyone finally admits that the emperor has no clothes, the scramble for the exits happens in days, not months. Don't let the red candles on your screen blind you to the reality in the vaults. The vault data is real. The delivery notices are real. The Indian premium is real. The screen is just pixels and algorithms designed to keep you calm while the smart money positions for what comes next. If you want to understand how we got to this point and why the bullion banks have been trapped in this corner for months, you need the full context. I did a deep dive on the short position spiral that set up this January squeeze back in my previous video. Go watch that. You need to see the chain of events that led to this moment because this isn't random chaos. This is the inevitable result of structural imbalances that have been building for years. The January squeeze is the preamble. March is going to be the main event. And I'll be here, analyzing the data in real time, cutting through the noise and sharing exactly what I'm seeing before the mainstream media even understands what questions to ask. The banks can manipulate the ticker, but they can't manufacture physical metal out of thin air. And that's the constraint that's going to define the next phase of this market. Stay sharp, watch the vaults, and do not let the paper price convince you that everything is fine when the physical reality is screaming the opposite.